Dividends could be a great way to make passive income. But how exactly do you find high-paying dividend stocks or ETFs? Because the last thing you would want is to invest in any high-yield dividend ETF and fall straight into a dividend trap and lose a bunch of money while doing so. Look no further, because I found the 5 best monthly dividend ETFs that consistently grow in value since their inception with a high dividend yield. Starting with number 5, JEPI, or the JP Morgan Equity Premium Income ETF. This dividend ETF is actively managed, and it generates income by selling options on US large cap stocks that are in the S&P 500. Since its inception in 2020, JEPI has had an average annual return of 13.67%, meaning if you invested $10,000 from day one, you would now have a total value of just under $14,000. Not bad. This ETF currently holds 131 stocks, which includes companies such as ExxonMobil, Visa, and Coca-Cola. With an expense ratio of 0.35%, you can expect to pay $35 on every $10,000 invested. For an ETF that is actively managed, 0.35% is actually not that bad. But what makes this dividend ETF stand out from the rest of the pack is the dividend yield. Currently, JEPI has an annual dividend yield of 11.67%. Now I know what you're thinking, Brandon, this has to be the most classic example of a dividend trap. You bum. Okay, typically I would agree, which is why I put this number 5 on the list. Not only does this ETF not have longevity since it was created in May of 2020, but add to the fact that it is actively managed, 11.67% annual dividend yield is more than likely not sustainable unless the ETF continues to decrease in value, which would set up the classic dividend trap. But seeing how the jury is still out on whether that might come to fruition, JEPI has the potential to be something great. If that was number 5, I'm excited for the rest of the list. Moving on to number 4, we have ticker symbol DIVO, or the Amplify CWP Enhanced Dividend Income ETF. This ETF seeks to provide income as its main objective while also providing capital appreciation. DIVO invests the majority of its assets into US paying dividend stocks while also writing call options to generate additional income. Since its inception in 2016, DIVO has had an average annual return of 12.02%, meaning if you invested $10,000 from inception date, you would now have a total value of just over $20,000. This ETF currently holds 32 stocks, which include popular choices such as Microsoft, JP Morgan, and Home Depot. With an expense ratio of 0.55%, which is a little on the high side, I must say, you can expect to pay $55 on every $10,000 invested. Again, this ETF is actively managed, so temper your expectations a little bit, because trying to beat the market consistently doesn't bode well over time. As Warren Buffett says, buy the index. Last but not least, DIVO has a dividend yield of 4.77%. Kinda juicy. Now, given how this ETF has only been around since 2016 and it is actively managed, I can't go any higher than number 4 on this list. But wait, it gets better from here. Starting with number 3, we have ticker symbol CDC, or the Victory Shares US EQ Income Enhanced Volatility WTD ETF. WTF. This dividend ETF tracks the 100 highest yielding dividend stocks in the Nasdaq Victory US Large Cap 500 Volatility Weighted Index. Damn, they need to cut these names down, man. Since inception in 2014, CDC has had an average annual return of 10.83%, meaning if you invested $10,000 from inception date, you would now have a total value of just under $25,000. Pretty good. CDC currently holds 104 stocks, which includes companies such as Merck & Co., American Electric Power Co., and others. Now, CDC does have an expense ratio of 0.39%, which is lower than our last pick, so you can expect to pay $39 for every $10,000 invested. We're getting there, guys. We're getting there. Now, since this ETF tracks an index such as the Nasdaq Victory, you can expect to be less risky compared to any actively managed fund, like the last 2 on the list. So that's a plus. But make no mistake, with the dividend yield of 3.41% and the continual growth of this ETF, this can be a top choice for many. Just a quick reminder, towards the end of the video, I will be explaining what a dividend yield is and how it pertains to money going into your account, or your wallet, or your pillowcase, or you get what I'm saying. 2 monthly dividend ETFs left on this list, guys. Let's not waste no more time and move on to number 2, which is ticker symbol DHS, or the Wisdom Tree US High Dividend Fund. This ETF tracks the price and yield performance of the Wisdom Tree US High Dividend Index. Think I got that right. Now, automatically, one of the highlights of investing in this monthly dividend ETF is that it specifically invests in the highest paying dividend stocks, obviously. Now, the inception date for DHS could be an attractive one for investors because it has been around since 2006. So if you value a long track record in the stock market, this might be a good choice. In the past 10 years, DHS has had an average annual return of 10.04%, meaning if you invested $10,000 10 years ago, you will now have a value of just under $28,000. That's pretty damn good. DHS currently holds 396 stocks, which include well-known companies such as Pfizer, AT&T, etc. With an expense ratio that is similar to our number 3 on the list, CDC, DHS has an expense ratio of 0.38%, meaning you can expect to pay $38 for every $10,000 invested. So just to recap, DHS has the longest track record when compared to the other ETFs on this list. It is not actively managed, has a fairly low expense ratio, and an above annual average return in the past 10 years? What are we missing? Oh yes, that juicy dividend yield, which comes out to 3.36%. Pretty damn good. All right, you made it. The number 1 monthly dividend ETF on this list is none other than ticker symbol SPHD, or the Invesco S&P 500 High Dividend Low Volatility ETF. Yes, this ETF tracks the S&P 500 Low Volatility High Dividend Index, but more specifically tracks the top 50 least volatile, high-yielding stocks of the S&P 500 index. Damn. Now, SPHD has not been around as long as our last ETF, DHS, but with an inception date of 2012, having over 10 years of history in the stock market, you can still be confident in this ETF. In the past 10 years, SPHD has had an average annual return of 10.11%, meaning if you invested $10,000 10 years ago, you will now have a total value of just under $28,000. Yes. Now, SPHD does hold just 50 stocks, but those do include companies such as AT&T, Kinder Morgan, etc. Now, I know what you're thinking. Brandon, 50 holdings is not a ton of exposure, you bum. Yes, I know, but the goal of this ETF is to track the top 50 least volatile, highest yielding stocks. Why is this important? Well, lower volatile stocks tend to see slower growth, but definitely slower declines. And for dividend investors, that might mean everything to you, because as long as I'm not losing value over time, and I continue to get my paycheck of dividend income, I'm good. Am I right? Last but not least, SPHD has a dividend yield of 3.82%. Pretty damn good. Now, combine the respectful yield of 3.82% and the continual growth of the dividend distributions combined with the growth of overall total value of this ETF, this easily makes number 1 on the top monthly dividend ETFs for 2023. All right, Brandon, sounds cool. You did your research, but I mean, you're saying all this talk about dividend yield, 3.82%, etc. But what the hell does this even mean for me? What does it mean when it comes to translating money in my pocket? Just tell me already, bro. Okay, it's simple. Look up any stock or ETF on any website, could be Yahoo Finance, Google Finance, any broker website, etc. Look up the stock or ETF, find what the dividend yield is for that stock or ETF and multiply it by the current trading price. And that will give you the annual dividends per share. So let's use SPHD as a quick example. Since SPHD has a dividend yield of 3.82%, and let's say the only information you have is the dividend yield and the trading price of SPHD, which during the recording time of this video is $43.80 per share, you would multiply $43.80 times the dividend yield of 3.82%, which equals $1.67 essentially. So let's round down, for example, and you get $1.67 of annual dividends per share. Since SPHD pays dividends monthly, divide $1.67 by 12 and you get your monthly dividend distribution amount per share. So if you have 1,000 shares of SPHD, you multiply the amount of shares that you own, in this case 1,000 times $1.67, which equals $1,670 in annual dividends for owning just one ETF. Quick bonus tip, whatever broker you use to make your investments, check to see if it has a DRIP or a dividend reinvestment plan. This way, the dividends that you earn can be reinvested back in the fund or ETF, and it can compound exponentially, leading to higher gains, higher passive income for the rest of your life. Links for all the research that was done in making this video will be included in the description box. I appreciate all of you, and check out this video here or here on how you can make your first ETF investment. Peace.